Welcome to the Deep Dive, your shortcut to staying informed. Today we're digging into Sprinklr's Q2 fiscal 2026 earnings. They reported on September 3rd.
Yeah, and it's a really interesting one. We'll unpack the numbers, the strategy changes, and how the market took it all in.
Because that reaction was a bit curious, right? Strong result, but the stock dipped.
Yeah.
So our goal here is to figure out why that happened and what it signals.
Exactly. It's often about reading between the lines of these earnings calls. What's the underlying story?
Okay, so let's start with that snapshot. The headline numbers looked pretty good. Sprinklr actually beat analyst expectations. Both revenue and non-GAAP EPS were ahead.
Right. And when we say non-GAAP, we mean adjusted earnings, sort of stripping out some unusual items to see the core performance.
And that non-GAAP EPS came in at 13 cents. The consensus was $1.10. That's a solid 3-cent beat. Pretty significant upside, about 30%.
And the revenue, $212 million total. That beat the street by about $6.6 million. It's also up 8% compared to last year.
An 8% growth year over year. But the really eye-catching thing for me was profitability.
Oh, definitely. Non-GAAP operating margin jumped to 18%. That's up from just 10% the year before. Shows they're really managing costs effectively.
18% margin, 8% growth. Those are strong headline figures. But then there's the market reaction.
Yeah, that's the twist. Despite the beats, the stock closed down about 10% after the call.
So investors were clearly looking past those headline wins. They must have seen something, maybe in the details or the outlook, that gave them pause. Let's dive deeper into the financials.
Okay, so core subscription revenue, the really predictable part, grew 6% year over year. That's $188.5 million.
Still growing, but maybe slower than the total revenue growth.
Well, yeah, 6% versus the total 8%. Professional services likely making up the difference there. Cash flow looked healthy, though.
How healthy?
Generated about $30 million in free cash flow, $29.8 million to be precise, and nearly $35 million in operating cash flow.
And the balance sheet. Still solid.
Very solid. About $474 million in cash and investments, and importantly, zero debt. Gives them a lot of flexibility.
What about winning new business, especially those bigger deals?
They're still landing them. Added 3 new customers spending over $1 million a year on subscriptions. That brings the total count of those big clients to 149.
And the revenue from that group is growing.
Yeah, the trailing 12-month revenue from that cohort actually went up both year over year and quarter over quarter. So the focus on enterprise seems to be working on that front.
Okay, what about future contracted revenue? RPO.
Right, remaining performance obligations. That grew 4% year over year. And the current portion, CRPO, what they expect to recognize in the next 12 months, that was up 7%. So decent visibility there.
But there's always a but, isn't there?
Well, the net dollar expansion, or NDE, was 102%. It was flat compared to the last quarter.
102%. So existing customers are spending, on average, only 2% more than they were a year ago.
Exactly. It reflects what they called ongoing elevated customer churn and downsell activity. They're adding big new logos, but keeping existing ones growing at a faster clip is still proving challenging.
That's a key dynamic. Landing new ones, but maybe struggling a bit to expand the existing base significantly. What about returning cash? Buybacks.
They finished their $150 million buyback program early in August. In Q2 alone, they bought back 16.5 million shares for about $140 million.
Okay, putting it all together, that rule of 40 metric comes to mind. Growth plus margin. Where do they stand?
Good point. With 8% growth and that 18% non-GAAP operating margin, they're at 26%.
So significantly below that 40% benchmark that healthy software companies often aim for. Shows there's work to do on balancing growth and profit.
Which leads perfectly into their whole strategic transformation narrative. Management kept stressing that this fiscal year, FY26, is a transitional year.
They broke it into phases, right?
Yeah. They said phase 1, business optimization, is mostly done. That covered things like strategy, systems, costs, go-to-market changes, product roadmaps, basically getting the house in order.
And now?
Now they're in phase 2, transition. This is expected to run through the rest of this fiscal year and into FY27. It's all about making those changes stick, embedding them in the operations and culture.
The goal being?
Durable growth and predictability, making the business more consistent.
That's like a major undertaking. And it involves some big leadership changes, too, which always catches the market's eye.
Definitely. The big one is the CFO, Manish Sarin, departing on September 19th. The CEO, Rory Read, is stepping in as interim CFO.
An interim CEO, CFO. Yeah, that can make investors a bit nervous about stability.
It can. But at the same time, they announced some key hires aimed at driving this transition forward.
Like the new chief revenue officer.
Exactly. Scott Millard, coming over from Dell where he led global AI sales, he starts September 22nd. Seen as a crucial hire to sharpen their sales strategy, especially around AI.
AI is clearly a huge focus. Anyone else?
Yes, Bit Rambush joined in August as head of global services and support, comes with a lot of experience, most recently from Philips Healthcare, and reports directly to the CEO.
So management's view is these hires will actually accelerate the turnaround, despite the CFO change causing some near-term jitters.
That seems to be the message. It signals they're serious about execution, particularly in sales and service.
Okay, let's talk about customers again, specifically that churn and downsell issue. They launched something called Project Bear Hug. Sounds cozy?
Yeah. It's basically a big back-to-the-field push they started in March. The idea is to really engage deeply with their top 700 customers.
Why those 700?
Because they represent something like 80 to 90% of Sprinklr's total revenue, so securing those relationships is critical.
And what kind of churn are they seeing? Is it customers leaving entirely?
Mostly it's downsell. Customers reducing how much they spend rather than full logo churn. Management pointed particularly to mid-market clients and maybe some who overspent during the pandemic boom.
That makes sense. A lot of companies are right-sizing contracts now. Is this bear hug actually working?
They say they're seeing early positive signs. The number of accounts they flagged as challenged peaked in May-June, but has apparently drifted down into the teens since then.
So better engagement seems to be starting to stabilize things, at least with those key accounts.
Yeah, suggests the initiative is having some impact.
Now let's pivot to AI. Sprinklr calls itself an AI-native, Unified-CXM platform. That's a big claim. What are they actually doing with AI?
They're putting investment into accelerating AI features, especially in marketing insights, and their CAS product.
CAS, that's contact center as a service, right?
Yeah.
Cloud-based tools for managing customer interaction.
Exactly. Phone, chat, email, all that. They're also adding more channels like video to the main platform and boosting their technical teams globally to support it all.
Any specific new AI products coming?
Yeah, a couple interesting ones. Sprinklr AI agents, think chatbots, but hopefully smarter for 2047 support. And Agent Copilot, which is AI assisting human agents, automating tasks, pulling up info quickly.
So automating some interactions and making human agents more effective for the complex stuff. Makes sense.
They're also enhancing their customer feedback management CFM product, using AI to analyze feedback from, surveys, social media reviews, all sorts of places.
Sounds powerful.
Yeah.
But AI isn't cheap, right? Especially cloud computing costs?
No, it's not. And management was upfront about that. They said strong customer uptake of these AI tools is actually driving up their cloud and hosting costs.
How much impact?
Expected to reduce gross margins by about 2 to 3 percentage points in the second half of the year.
Lower margins isn't usually what investors cheer for.
True, but it's a bit of a double-edged sword. It does suggest customers are actually using the AI features, which could be a good sign for long-term adoption and stickiness, even if it hurts margins short-term.
That's a fair point. Usage is key. Are they changing how they charge for things too?
Yes, a new hybrid pricing model for new customers on products. It combines the traditional seat-based pricing with a consumption-based element. The idea is to make it simpler to buy and maybe tie cost more directly to value.
Okay, lots of moving parts. Strategy shifts, AI costs, pricing changes. What does this all mean for the outlook? Let's talk guidance. Q3 looked a bit soft sequentially.
It did. For Q3, they guided total revenue to $210 million. That's about 4% year-over-year growth at the midpoint. Subscription revenue guidance is $187 million, only about 3% growth year-over-year.
Why the step down from Q2?
They attributed it to, and I quote, continued necessary cleanup of challenged accounts from the past. So still working through those downsells from Project Bear Hug.
Got it. And earnings for Q3?
Non-GAAP EPS around 0.09 cents, with operating margin around 14% at the midpoint. Again, reflecting those higher AI costs and other investments.
So near-term caution baked in. But they did raise the full-year guidance.
Yes, they did. For the full fiscal year 2026, total revenue is now expected to be $839 million. That's up about $12 million from their previous range. Represents about 5% growth year over year at the midpoint.
And subscription revenue for the year?
also raised slightly to $748 million. That's about 4% growth. Non-GAAP EPS for the year is guided to $0.42 or 43 cents, implying a 16% operating margin.
So lifting the full year despite the soft Q3 suggests they expect things to stabilize or improve a bit in Q4.
Seems like it. And free cash flow for the year is still pegged at $125 million, though they warned Q3 might be slightly negative cash flow because of the investments.
Management also talked about expecting a bend in the business. What's that about?
Yeah, they use that term. They expect an inflection point, a bend in metrics like renewals, customer satisfaction, growth, sometime in the second half of this fiscal year, maybe bleeding into early FY27.
So basically they're saying, be patient, the positive results from all these changes are coming, but it'll take another quarter or two to really show up in the numbers.
That's the essence of it. And specifically for their CKS business, they plan to really push for growth in FY27 once they feel the service levels are fully hardened this year. It's a phased approach.
Which brings us right back to that market reaction. The 10% drop despite the Q2 beats and raised full-year guidance. It really highlights that gap between current results and future confidence.
Absolutely. Investors seem laser focused on that softer Q3 guide and the CFO transition uncertainty. They want proof, not just promises, that the new CRO can re-accelerate growth and do it without sacrificing those hard-won margin improvements.
It's the classic growth versus profitability tension, especially in software right now. Everyone wants both.
Right. And Sprinklr's path back towards that Rule of 40 target is clearly under scrutiny. They're at 26% now, so there's a way to go.
So looking ahead, what are the key things investors and we should be watching? What are the catalysts?
Number one is execution against that Q3 guidance. Can they hit those numbers despite the cleanup? Then any early signals from the new CRO pipeline build, key wins. Also, adoption rates for those new AI features.
And resolving the CFO situation.
Definitely. Updates on the search for a permanent CFO will be important for stability. And of course, the overall market mood towards software stocks always plays a role.
What about M&A? Are they looking to buy growth?
Their focus seems to be smaller tuck-ins or acqui-hires, primarily to add specific tech or talent in AI, CKS, or social. Not big, splashy acquisitions, more about disciplined capital use to boost organic efforts.
Okay. This is not financial advice, folks. Just a thought experiment based on everything we've discussed. Sprinklr's situation is intriguing, strong execution on cost, a clear transformation plan, but the market is punishing them for near-term uncertainty and slower growth.
Right. The stock took a hit, creating this potential gap between current price and where management thinks the business is heading by late this year or early next. That bend they keep talking about.
So, if you believe in that long-term story, that the new leadership and AI push will eventually re-accelerate things.
Here's an admittedly outrageous, but maybe plausible idea.
Let's hear it. Okay, consider establishing a deep-in-the-money call option position, maybe looking out to January 2027. Pair that with selling a shorter-term, out-of-the-money put option, say for December 2025 expiry.
Interesting combo. What's the logic?
The deep ITM call gives you leveraged upside exposure if the stock does rally into FY27 as that bend happens, but with less capital than buying shares outright. The short OTM put sale collects premium now, taking advantage of potentially higher volatility and market skepticism around Q3.
So you capture potential long-term recovery with the call and harvest some near-term fear premium with the put.
Exactly. If Q3 causes more wobbles, you keep the put premium. If the stock rallies sooner than expected, your long calls gain value. It kind of plays both sides, acknowledges the current anxiety, but bets on the longer-term turnaround story management is selling. Again, not advice, just a way to think about structuring a view based on the current dislocation.
It definitely reflects that tension between short-term caution and long-term optimism.
All right, let's wrap this up. To recap, Sprinklr's Q2 showed solid beats, better margins, clear signs of operational discipline.
But they're deep in a strategic transformation. Project Bear Hug is tackling customer downsells. Big leadership changes are in motion, and they're pushing hard on AI innovation.
The market, though, reacted cautiously, focused on the CFO change, the slightly softer Q3 outlook, and waiting for proof of re-accelerated growth.
Management remains confident they'll hit that bend in the coming quarters, but it really underscores that investors want to see consistent execution matching the narrative now.
Especially in this market environment, where profitable growth is the name of the game.
For sure. The focus shifts now. Can the new team deliver? Can the AI investments translate to durable growth?
Remember, this deep dive is just to keep you informed, not to tell you what to do. Always do your own homework and talk to a professional before making investment decisions. The big question hanging over Sprinklr now is whether this transition phase leads to a genuine, sustainable inflection point, proving their bend is real, and that they can carve out a leading space as that AI-native CXM platform.
Time will tell, but it's definitely one to watch.